In this video, we are going to talk about dollar cost averaging. Think of dollar cost average as a viable means of navigating a volatile market without having to gauge the best entry point. DCA is a method in which an investor invests a large sum of money in modest increments over time rather than all at once. The basic idea is to profit from market downturns without putting too much money at risk at any given time. DCA is intended to help counteract the negative impact of short-term market volatility on an investment. If the price of an asset falls during the time you're dollar cost averaging, you will profit if the price rises again. DCA can save you the time and the effort of trying to time the market to get the greatest stock prices if you aren't a professional market watcher. It's a method for investing slowly and steadily with the goal of avoiding the human need to obtain everything at once. Dollar cost averaging requires you to first decide on the entire amount you want to invest as well as the investment products you want to use. Could be stocks, could be coins, commodities, and so on. The money is then invested in smaller, equal installments over a certain period of time rather than as a big sum. You can perform your DCA transactions manually, but there are also vehicles that can handle it for you, including 401k plans and some dividend reinvestment plans. Your purchases will be made automatically once you have set them up, regardless of asset price or market movement. Now, in case of cryptocurrencies, DCA is much like placing an order for a recurring buy on a cryptocurrency exchange like Coinbase. Cryptocurrencies can be quite volatile, oftentimes even more than the stocks. You can generate a potentially greater profit from buying during dips and selling at the top. However, there's a broad consensus that DCA is a safer overall method of investing than lump sum buying and selling. It's lower risk and lower reward, but still offers the chance of benefiting from market swings. One change you can do to DCA strategy in case of crypto is to time your buys around the dip. You don't have to specifically time the market, but for this one, if you see that the crypto is already swinging at a very high value, you probably want to wait for a few days before you invest into it. Also note that this DCA strategy is more applicable to relatively stable cryptos like Bitcoin and Ethereum, but might not be as fruitful for altcoins like Dogecoin, etc. After all, DCA strategy is for long-term hodlers, and if you are in crypto for short-term pump and dump, then DCA strategy is definitely not for you. Also, DCA wouldn't work if the market prices are relatively flat over a long duration of time. For example, in the case of stable coins like USDT, Tether, and USDC. Another point to note is because many trading platforms charge a fee each time you make a transaction, you're going to incur more trading costs with a dollar cost averaging strategy. The good news is that DCA is inherently a long-term strategy, so ideally, fees should potentially become small relative to your potential gains over 2, 5 or 10 years and beyond. Let me give you an example of DCA with S&P 500 and then I will show you how the same can be applied to Bitcoin market. Investing $500 per month in an index fund that tracks the performance of a broad market index such as S&P 500, in some months the index will be priced high, meaning fewer shares will be purchased for the $500 investment. In other months when the index is low, $500 would purchase a greater number of shares. Now let's see how the same concept can be applied for Bitcoin. For Bitcoin, let's dig into an example using the real world prices right as they approached Bitcoin's biggest downturn to date. If you invested $100 in Bitcoin every week starting on December 18th, 2017, you would have invested a total of $16,300, but on January 25, 2021, your portfolio would be worth approximately $65,000, a return on investment of more than 299%. In contrast, going all in as prices are peaking is generally considered a bad idea, but how could you know? Well, if you had taken that same amount of $16,300 and invested it all on December 18th, 2017, you would lose nearly $8,000 throughout the first 2 years. Although your portfolio would recover eventually, you would have lost out on the ability to compound your profits in the meantime, and well, maybe even scared yourself into selling your Bitcoin at a loss. To know if DCA is the right strategy for you, it's important to think about your unique investment circumstances. It is always best to consult a financial professional before undertaking a new investment strategy. With that advice, we will end this video. Let us know in the comments if you are a fan of DCA strategy like many viewers of this channel, or you prefer lump sum investment. Like, share and subscribe. Thanks for watching. Have a great day.